Okay, so let's go into trend analysis, which I think a lot of you have a good idea with. First thing we do is moving averages, right? It's our first kind of like order of defense. How to use moving averages to analyze trends, how to use moving averages to guide your trading approach, how to identify strong stocks and weak stocks. We could do a lot of that with using moving averages. I do view them as the most important roadmap. Moving average is the average stock price over a certain number of days. Exponential gives you a bigger weight to the most recent days. Someone's like, well, the simple is here or the exponential is there, and it's not an exact science. It's really a zone, especially with the day and age of algos. They're all looking to stop people out one way or another. So it's instead of like a pencil, it's like a magic marker. So I use the exponential just because that's what I've been used to using. But it's really just like the blend of what the trend is and what the momentum is, and sometimes I'll get a little bit of both of them, because I'll be like, oh, like the other day, like the spiders, I'm like the 200-day is here, we were almost there, and someone's like, oh, we're already through it on the simple. So it's not an exact science. It's like just it's a zone. But the same thing with the 8 and 21 day. So or the 8 and 10 day. So I'm like, Redler, why do you use the 8 day instead of the 10 day? Or why don't you use the 9 day? It's really the same kind of thing. You could see when momentum leaves. So using the 8 day maybe gives you a little, it's a little bit more of a smaller time frame than the 10 day. Same way, I use the 21 day instead of the 20 day. It's also, it's not exact science. It's just, hey, if you're breaking the 8 day, all of a sudden, you're feeling fit. You could do a marathon now. Maybe you have like a little bit of a twinge in your calf. So that's like breaking the 8 day. So you could still kind of run the marathon, but you run it and you don't feel as good. Then all of a sudden you break the 21 day. Now your ankle and maybe you pulled your hammy a little bit. So now you're it's a little tougher. You're not in as good a shape. The market's not in as good enough shape. The stock you're playing doesn't have the momentum. It's not feeling like it's ready to do the New York City Marathon to qualify for Boston. Anyone ever do that? I did. I qualified for Boston, 3:13. Well, I ran Boston. But I'm saying, so when you're above the 8 and 21 day, it's like, you're healthy, you're strong, there's momentum, and you want to stick with that. You start breaking the 8 and 21 day, it's like, okay, maybe you're a little worn out. Maybe you've been in this trend for a long time. Maybe it's time to, for things to correct a little bit. Like me, okay? So I had back surgery in 2016 because I did 2 Ironman and 10 marathons. It was time for me to go through a corrective phase. So I broke the 8 and 21 day after a strong stretch of 2 Ironman and 10 marathons. It was time for me to, go back to my 50-day moving average and hang out there for a while and figure out what I could do next. And I started doing trail races. So then started to start a new trend in a different area, like a whole new sector. So
I saw you running in the snow with your hat and your dog.
Oh, Wim Hof.
Yeah.
Anybody know who Wim Hof is?
Oh, yeah.
You know who Wim Hof is?
No.
All right, write down Wim Hof. You got to look him up. You know who Wim Hof is? He does mind training in the cold. The Iceman.
Yeah.
The Iceman.
He actually taught me how to hold my breath for 2 minutes.
Yeah.
Oh yeah.
This method of
I was like, that's impossible. And I timed it. I'm like, oh my God.
Did you do it underwater?
No, I mean I just.
No. Then you really didn't hold your breath.
Right.
Meanwhile, I have the Ukrainian cold plunge world record right now.
Really?
I do. Last time I was there, I'll tell you that story over drinks.
Scott, question on the EMAs. What period of time do you look at? Those numbers will change if you're looking at it 3 months, 6 months.
I use it on the daily, and I think the chart that I have is on 90 days.
Okay.
So usually the 8 days is usually based on the daily chart. That then you could do, like, some people use like the moving averages throughout the course of the day, intraday, or a Keltner curve, But I usually when I talk about something breaking the 8 and 21 day in the trend, it's usually on the daily. Like now I'm going to the weekly charts and it's all different too.
So daily have 90 days.
Yeah, daily have 90 days. Some people use 120.
Right.
It all depends. But again, it's it's like a zone. It's different. So like I was just like looking at the weekly charts and I saw where they broke the 8 and 21 day also. I'm like, wow, you could have used the 8 and 21 day on the weekly. If you trade it, if weekly is your time frame, then the weekly. If daily is your time frame, it's daily. If sometimes people just day trade, it could be on an hourly time frame. But if you break that 8-minute or whatever it is, that just means that it's not as strong as it just was in the last little time frame that it was in. So we'll get to that. So what it does, it gives you like an instant look of the health of the trend. You can see it right away. Same way like, a back surgeon sees an x-ray or an MRI of someone's spine and they can say, oh, it's a healthy spine. Or they can say, oh, look at that bulge right there. Or, oh, so they're trained to see. So the same way you guys are trained to see, charts and patterns, moving averages give you a glance of, wow, okay, that's a really nice trend. It's been in it for a long time. Or, oh, wow, that's choppy. That's crazy. I don't want to be near that. Or when you see big holes in the chart, which we'll get into gap analysis also. So this helps you get your opinions out of the way. For those who love to short, sometimes I'm like, they want to short just because it's up. I'm like, you can't short just because it's up. If it breaks the 8-20 one day, hey, maybe now it's time to look for some shorts using the H-cell setup, which we'll get into. So the 8-21 days is a short-term trend. And it helps you with the active complexion, which is where we live. The 50 days intermediate, and the 200-day is more long-term. I always say, hey, in order to get to the 200-day, what do you have to do first? Yeah. So isn't it nice to sell the 8-21 day and then you can test the 200-day? So like just say the 8-21 day is at 80, you get out of the way, and then the 50 day is at 70 and the 200 day is at 60. If you sold this at 80 because it broke the momentum trend, then you get to test it a little bit here. It breaks, okay, it's still weak. Test it here. Doesn't work. So at least you're testing there instead of just holding your breath and going on the water the whole way, like a lot of people did with those, those growth names. So let's break down some of these.
UPST.
That we'll go at some point, later in the week, when I use TrendSpider, we'll look at the charts of everything that we've been looking at for a while and go over that. This we're going to stick to what's it called, the presentation. So, right here's the SPYs. Looks like a strong trend, right? Above the 8-day, above the 21-day. This went on for quite some time. This is a short-term, active, beautiful trend where you're probably sitting in 20 names or 10 names, whatever it is that you're comfortable with. What was like the most amount of names you ever sat in for 1 3-month time period?
Maybe 15.
Okay.
Not including options.
Not comfortably, but probably 40.
40?
I followed a couple of different services, and I've made some big mistakes this year.
Oh.
We all have.
We all have. But how many are you in now?
Right now, 1.
Okay. So, but the sooner you adjust, the better.
I own Peloton, so that's my confession. Oh, no.
Meanwhile, we played Peloton awesome a year and a half ago. I don't know if you got right. 25 to like 90, we played Peloton or something like that.
Peloton was it's very intriguing because I'm like, dude, it's a bike.
All right, we're not talking about Peloton now. How many positions at most?
No more than a dozen.
Okay.
And right now, I have no longs.
Okay, so you're in tactical mode.
I'm flat right now.
So you're just going to play the ranges. Create money, take it.
Most of it has 18 when it was really going well.
Okay.
But I'm flat, and I've got 4 in a long-term account.
Okay, so you're pretty tactical and ready to go also.
Maximum, I think 25, 30. I think similar to what you had basically.
Okay. How long you been on the Alpha team?
1.5 years.
Okay,
Yeah,
so
I mean, that was a good time to join. October 2020.
oh, so good.
Yeah.
Yes,
That was like.
that was a great time.
Yeah.
I find though if you have
If you have too many,
more
it's
than
hard.
10, it's like herding calves. You just
Right.
one of them gets away. It's like that's.
No, I hear you. I've been doing this for a long time, and I remember, 7 years. There were some people who came back to the virtual trading floor, and they're like, "Holy shit, Redler, you have 30 longs." Because, a decade ago, maybe I had 6, that I felt comfortable with, and then maybe, 2 years later, I felt comfortable with 9, and then, I guess through time, and through experience, you could evolve, and we're all evolving. We're all trying to become the best version of ourselves. So at some point, I had like 40 positions, and he's like, how'd you wind up doing that? I'm like, they're all above the 8-21 day. I have a reason for them all. I'm massaging them with my tier system. I'm doing everything I could do, and then obviously, when the trend breaks, they go from 40 to 20, right when you break the 8 day, and then you're at 20, like, wow, that hurt a little bit. Thank God I had some hedges, and then all of a sudden you break the 8 day, now you go from 20 to 6, with a hedge or two, and then all of a sudden doesn't get above it, and then that's how you go from a portfolio to tactical. But sometimes it's good to just sell into the strength and not get caught, on that bad P&L day when you get a surprise, which happened every now and then, especially when Trump was president with, I remember that Sunday night that he said he's putting the taxes back on China. I don't know if you guys remember that Sunday night. I think we closed awesome on like a Friday, and then he said that, and then we gapped down 500 points. But anyway.
I freaked out when he came out with the GDP numbers? The non-farm payroll numbers?
Early?
Yeah.
Oh. Anyway, we'll get it. So there's this nice strong trend above the 8-day. Okay. Here also, this is kind of like a decent intermediate trend, right? If you're some people who don't trade for a living, who have a job and want to be in the market and don't have as much time to be active like us, you use the 50-day. So here it's still holding the 50-day, still trending. Here's obviously more momentum and healthier than a few of these. And then this is you can see the 200-day, right? So again, if you just say you sell when the 8 and 21-day breaks, you have the opportunity to test the 200-day without being in pain. Here if you sold when the 8-day broke, you could have tested the 50-day. So as an active trader, you're really only trying to be in a lot of risk when you're above the 8 and 21-day. So this way, when things change and things test lower level, more intermediate, where the institutions put money to work, or some hedge funds that say, okay, I'm only buying long term on the 200-day, or everyone has their own covenants. So my covenant is I want to be risk on when we're above the 8 and 21-day, and when we're not, I try and be tactical, and then I try and be short if the setup's there. So I just know the way I tick. Sometimes, even like last week, you could lose a little money in your longs, then you're like, okay, now I'm going to flip short, and then you walk in the next day and you're up 25 hands. You're like, wow, I just got stopped out of my longs, and then I just pressed short, so now I'm going to lose my short, and then you just your psychology leaves. So if you feel like that's going to happen, then say, okay, I'm just going to step back and wait for those select, pivots that make sense to make money long, because you just know that you're not wired yet to be able to do both, which hopefully over time we all get wired enough where we could make a little bit of money both ways. And so, some people know, like every now and then when they start to see me have like 2 or 3 hedges, I'm starting to get a little bit more bearish, and like people read me where like, okay, now he went from 20 positions to 6, and he's short the SPYs and the Qs. Okay, so that means I should be shorting things that I want to short, especially if they're a good short. Some people say as soon as I sell a long, they want to get short, because then they know that I think it's not going up, so they just could tell it's going to go down. So there's lots of ways to read into some of the things that I'm doing. So that's when it tests the 200-day. So the 2 trading approaches is, again, above the 8 and 21-day, you're in portfolio approach. All 5 of you have a different type of portfolio approach. As you said, you were once in 40. You said like 12. It's different for everyone. It's all based on your mindset and what you can handle risk-wise. And then there's tactical, when you start to break the 8 and 21-day, and you no longer get paid for sitting in things and just massaging them, and it's time to take risk off, because anything can happen when you're below the 8 and 21-day, which we're starting to see now. And that's what keeps you safe. Protect your chin. If the SPY is below the 8 and 21-day, I want to stay long with the SPY is above, the 8 and 21-day. You want to stay long in a portfolio approach. You try and rally short. Sometimes when you're extended above the 8-day, you want to use your tier system and trim some, and then maybe put an extra hedge on. But typically, again, you're above the 8 and 21-day. We try and be in portfolio approach. So let's flash back to a few different time frames when everyone said something was supposed to happen, but if you just used the moving averages, it would have kept you safe instead of on the wrong side. So the 2020 election flashback. Let's see. Recipe for chaos. 2020 election threatens to snap a U.S. already pushed to the limit. Why stock market investors are starting to freak out about the 2020 election, the election that could break America. So these were like the headlines. You would think you had to run for the hills. You would think you don't want to own a stock. You would think that we're ready to crash. According to every one of these, was probably from the Wall Street Journal, the New York Times, wherever. So this was where all those headlines were. Stocks just had their worst day in 4 months. Here's how the election could make things even worse. So we did break below the moving averages. That was all those headlines in October of 28, 2020. And then what happened? We took back the AIM-20 one day, and you had a nice trend. So for those people who said, hey, there's no way the market's going to go up after the 2020 election, it went up. And below the moving averages, you're tactical, above and holding. That's another nice trend. It's happened a lot of times. So here it breaks it down a little bit more, where stocks just had their worst day, Plus you could have been out of the way. And then here, reclaimed all the moving averages, and then set another portfolio approach for, for months. The COVID-19 crisis can teach you even more, right? So this was, first of all, look how you were below the 8-day this entire time. So right there, it's tactical risk off. I remember, I don't know if you guys remember, do you remember? I'll be very impressed where I was when I tweeted out that I'm going to tactical full cash, and I gave like 4 reasons why. Okay, I was in Florida I remember I was with Chase and I was with Selena with another couple, and I was sitting after a run, I was on the lounge chair, and I saw Amazon break a level, Apple break a level, and Spies broke a level, and I tweeted, I'm like, I am now in full tactical cash mode. And that was up here. I remember that. That was before this gap down. But again, look at this small little candle right here. Just got below the AIM-20 day before then, and if you didn't get out there, you had a pro gap and then took out the low from that pro gap, boom, out of the market. Could have saved you everything. 35% drop. And then even if you missed this first bounce, you then had a higher low, and then we took back the moving averages and wound up having an unbelievable trend that everyone fought on the way back up.
Right.
How'd everyone do during that year?
I did good on the way down, but on the way up, I was like, it's not going up. I was like, no, it's not going to do this. No, I know more.
Okay, so you have a lot to learn.
I didn't get my ass kicked. I missed out.
Right. That's kind of like getting your ass kicked.
Right.
Not as bad.
Right.
But I remember, during this process, was out of the way. Everyone in the world's freaking out, and you're out of the way. Again, if you're in the right approach, in the right type of market, you don't have to know exactly what's going to happen. You're just out of the way. I also, I remember I tried to help people with the long-term accounts. Remember, I told you about my long-term, my wife's cash account, the Blood in the Street account. Well, I waited. I waited because long-term, if we have a 401k, every single month you just put it in. You can't time anything. There are people who time the financial crisis. Oh, I got out in 2007, and then I'm like, okay, how are you now? It's like, well, I'm still in full cash. I'm like, well, you timed it, but you didn't get back in. Whereas every single month, fine. So that's one way to do it. Like, if your son, or your kids, my son's 13, so I have a 529. I'm not worried now. If when we were writing the report this year and I was at Barrich, if he was 16 and I was going to college in the year, I'd say, okay, time to reduce the risk in the 529. So you have to kind of know your age and where you're at. If you're 80 years old and you're in the market and you're coming into this year, it's different too. But everyone who's our age, 401k, every single month. But that's not your active account. That's your long term. So the Blood in the Street account that I have with my wife, because she moves from a state institution, that's in full cash. So everyone's like, did you start putting that account, which you guys could listen to too, back in? And I'm like, no. I'm like, Blood in the Street's Blood in the Street. The S&P's down 7%. That's not Blood in the Street. So I remember with the COVID, I started at 15% off the highs, and then I put her account in every 5% down to 30%, and I wound up, making her good money during that. So with this potential 3, 6, 9 months, we have no idea, how it's going to play out this year. In my head, I think what's going to happen is, we're going to get down probably in the S&P over 20% off the highs, and the NASDAQ like 25, 30% off the highs. And then same way Powell pivoted in 2018 and was like, okay, we're going to be a little bit more flexible. There will be some point in the next 3 months through this corrective crazy phase that the Fed will change their tune a little bit because everything's getting really beat up. And then that's when we get the Powell pivot of this year, but who knows? It might be in a month, it might be in 4 months. So, that's what we wrote about, Mikey, coming into this year too. And that's what we just did in another presentation. But who knows from where? So we map out levels and we're careful. So if the S&P is down 10%, which it could be in the next week or two, then I'll put a third of my wife's cash account in, and then I'll wait every 5% just for that account. So then here, you just say, this is the bottom, so you don't have to buy the bottom. This is when to reclaim the 8 and 21 day. And then gave you a really nice trend.
At that point, it's still 25% off the highs. Like, once it reclaims the 8 and 21 day, it's still 25% off the highs.
Right, so maybe you didn't catch the bottom, but you said, okay, you first move, high or low, back above the moving averages, you start to put on some positions that are working. And then here, broke the 8 day, we claimed the 50 day, and then it was a little sloppy again, but look how extended that was before that. So that's just in March 2020, traders were I don't think traders were terrified. I think the world was terrified. The traders were like opportunistic. It was a very, obviously tradable, profitable year. All right, so tactical approach. If SPY breaks the 8 and 21 day moving averages, I start taking profits and cleaning up loose longs. I also consider shorting some ETFs, or shorting some calls, which some of you have seen me do more of. Some guys like, Red Dog, why do you short calls in the SPYs? The risk is limitless. I'm like, well, it's the same exact things. If I shorted the SPYs here, I'm shorting calls there. I could be wrong for a little bit and still be right. So I only do that at key times. Sometimes psychologically, it's easier to say, hey, SPYs are trading here, $4 higher. I could short those for $1.50, and then it could get here, and by the time it gets here, it's expiring, and I could so 4 more points, and I get to keep the premium. So sometimes when you see me sell options, it's just a way of me saying, hey, I want to be short, but I don't want to be perfect here. I'm shorting a little bit higher. The one problem I do have, though, sometimes is I short more calls than I would have shorted the stock. So if just say you're comfortable being short 2,000 SPYs as a hedge, you shouldn't be shorting 50 calls higher, because if something happens, where it happened to me once or twice, where it super exceeded it, then you short 5,000 shares instead of short where you're comfortable 2,000 shares, then it's up 3 points, 4 points, you lose more that way. So if you're ever playing the options where you're shorting premium or selling premium, make sure that how many shares it correlates to. You guys follow?
Probably the reward is also limited, right? When you short calls,
right?
The reward is limited. I think that's the bigger problem also.
See that again?
Don't do it.
Right.
I mean, you only get the premium.
Right. So some people say, hey, why are you shorting calls? Why don't you buy puts? Well, if you buy puts, you have to be very right. Then all of a sudden, if it goes down a little bit or waits to go down, they're sucking the premium against you. Yeah. So you sell calls to be short, you could still be wrong and right. If you buy puts, you could make more, because like you go down 10. So like just say, you sold this, just say like we were talking about, that you thought the SPYs were going to break 450. If you sold the 455 calls for $1.50, you were never scared. You're like, I'm keeping the premium, it's not getting back there. But you're only able to keep the $1.50 if it goes down. If you bought the 450 puts, you could either have a 0 or they go to 8. And then there's 2 different ways to do it. So some people say, hey, I want to make money on the short side, but I'm not exactly sure, so making that premium is fine. And then some people say, I want the home run. We're breaking that, we're falling $10. I want to buy puts at 2, I want to sell them at 8, which we all want to do. But so that's it. You could do a little variation of both, right? Do any of you guys do that kind of stuff too?
Sometimes. I just buy puts.
Okay.
Yeah.
That's fine too.
But I'm more tactical.
But you have to be very right though, right?
I like selling calls. I like that.
Well, there's an art to it.
Yeah.
I made a lot of money in 2020 doing it. I would say last year, actually, into the end of the year when I was feeling bearish, when we were writing the report, I sold calls and they had that one push in the last end of the year, the SPYs, all the way to the highs. And I got converted into short SPYs, and I think we're in Orlando with triple the amount of SPYs short that I was usually short. I don't know if you were watching that on the Alpha team. And then we pulled in for the 4 days. Remember that little flag we had? And then I covered it, but then that was when I should have really said, okay, now we're rolling over. So by being too short at one point hurt me with my short thesis when the time was right. So that's another thought is, okay, the market doesn't know that you tried it. How many times have you tried something to buy it and it's not ready, and then you're like, I hate that stock, and then 2 days later it gets above it and goes. Or like you said, you're thinking it's going to break 450, you're trying to short it, and you're like, I'm not shorting this anymore, and then 2 days later it breaks.
The last 6 months.
Well, the thing is, again, that's mental. The market doesn't know you did it. So if you had an idea and the market wasn't ready for your idea to resolve and go in the direction of your idea, you just got to do it again. Maybe you don't do it as much as you did when you first tried it, but if you do it again and then it happens and you make money, it's a great feeling because it's hard to go back to something. But if you go back to it when the time is right and make money, you're like, wow, okay, it wasn't ready. Timing a breakout is a hard thing to do. Sometimes it takes multiple times. Timing a breakdown takes a few times. That's why sometimes, what you said is, if I think the S&P is going to be down, another 5% in the next month, why don't I just go out a few weeks and buy puts? It's not a bad idea. But again, we'll talk. I said what I think dynamically could happen this week, which would be a really good trading week if we do come in on Monday and futures are down a lot, and we can get some kind of buyable bounce, because we're so oversold, and then maybe some short covering into the Fed Wednesday, and then just say whatever we rally, we'll look at the charts. Maybe there you go out 2 weeks, and then you buy the puts of the low we just had, whatever that is. So this way, and you give it 2-3 weeks, and say, hey, if I'm wrong, it'll be a zero. If I'm right, at least I followed my thesis. And then if it's tradable, then you also will trade the ETFs based on how it goes. But at least you have your idea there. Because sometimes the algos screw you up. Like last week, you could have had a short thesis and still been hard to make money. My thesis was to be short, and I still, didn't make what I wanted to make short. So sometimes giving it room with less size just to let it work out is very helpful. So here, again, broke the 8 and 21 day right there. So get out of the way. If you get out of the way at the 8 and 21 day, okay, you can test the 200 day.
And look how it spiked up too to just mess with you.
Yeah, definitely. That could have definitely been like if you went home short that day, this push up could have definitely got you out, and then that. That's why, again, sometimes you go out a little bit with options, and it could be helpful. And then a triple bottom. You don't necessarily ever really see a triple bottom. Usually, double bottom, you don't hear of triple bottom because why? Usually breaks it. So again, but the moving averages help. Here, you're above right here. Even if you got out of half your positions here, saying, hey, I've seen this before, then the other half comes off right there, and I'm a lot better in here than there.
It's like an H setup with a retest of the H.
Here?
Yeah.
Yeah, well, if you shorted the bounce into the moving averages,
Right there.
you at least made some money, where here, if you pressed it, that turned into a red dog reversal buy, and it just wound up holding. And then you had a gap up here. You took back the moving averages. So if you bought here back above the 8 and 21 day, you actually had a nice trade as that gap happened there. So this was the taper tantrum of 2018. I remember this very well. So we broke below the 8 and 21 day. I remember hovering here, and I remember saying, if we get below this, get out of the way, and broke below the 8 and 21 day. First moved down to the 200 day. This is your H cell setup. Boom, H cell setup, and then broke the bottom. And then it rallied to it, got rejected, rallied to it, got rejected, and continued lower. But right here, that definitely would have ended the portfolio approach. Maybe right here, I could have got sucked in a little bit, but then once you broke back below that, right there, that could have been the out. This seems like it would have been a little tricky. This clear cut got you out of the way, and then here probably sucked in some longs.
Right there. The green,
Yeah.
igniting bar, and then the doji.
But this candle would have got you out. That's a big bearish engulfing. So even if you did get in here, that day probably hurt a lot. But it also came with a kind of extended, like look at that, you had a nice move, a little extended, bit of a doji, little exhaustion. So that right there could have got you out of, at least if you were using a tier system.
Like an evening star.
Yeah, before that. But again, using the moving averages helps you at least gauge how involved you want to be, long or short.
Do you ever do the 100-day moving
Yeah, sometimes but that's like a pause. It's not really that valid or that compelling. Some people use the 150-day moving average, you know. So, you know, again, when you're above the 8-21 day, you want to know what strong stocks look like, right? Because that's the ones you want to be in. That's where the leadership is. You know, it's again just like an indices. Stocks above the 8-21 day. Sectors should also be above the 21 day. Ideally, the stocks I target are showing relative strength versus the sector. So when the market turns, if there's a group that's like, just say like the S&P reclaims the 200 day, you want to then look at the group that's above the 21 day because it's showing relative strength to the S&P above the 200 day. So then if the S&P goes from the 200 day back to the 50 day, that group that was at the 21 day is probably on the verge of making new all-time highs. Does that make sense? You know, so you want to be, that's the best bang for the buck, you know, when a new rally starts. You know, the group that's holding up the best usually extends into all-time highs, and then if you see a group extend into all-time highs, you're like, wow, maybe this bounce in the market could be healthier because at least has leadership. So it also gives you clues that, you know, we could be switching gears back to more risk on. So NVIDIA. Okay, NVIDIA has been a strong stock for a long time. And NVIDIA recently in the last month gave you clues saying, hey, you know, tech could be vulnerable. So never short stocks trending above the 21 day. That's a definite thing to note. Semi stocks were very strong and NVIDIA also led, yes. Here, move above the 8 day, stayed, that's the 21 day, and that, you know, had a really nice ramp. But basically, it's a stock above the 21 day. NVIDIA has been above it for the majority of the time, so at least when it breaks below it, it's no longer there. And I'll show you that chart on TrendSpider when that changed. I'm sure you've seen it a bunch of times. Did try it on Friday. Friday was crazy with NVIDIA. They bounced it, went up $5, and then reversed and closed down 8. That was tricky.
Get those shorts.
So here is, you know, RBLX. This is a great setup, a strong setup, right? Months ago, why? You know, you had a nice gap up here. So you have an earnings gap that held the 8 day. So right here, you know, you see almost even like a bull flag being built, and then crosses above this, and it continues. So gap holds, protected it, lets the 8 day catch up, and then continues. This candle was probably a great day trading day as it cleared this spot. So you could either be like buying versus the gap pivot. That's one way to do it, right? If you don't want to time the breakout, you buy versus the gap pivot, and then you could add when it clears this, so that's like your tier 2. So tier 1, buying a versus it to be involved. Tier 2 gets above it and then continues to trend. But a stock that holds a pro earnings gap is typically a strong stock, and then a stock that stays above the 8 day is a strong stock. What about weak stocks? You know, stock is under the 8-21 day or gets rejected by it. It's a weak trend. Lower highs, lower lows. Anything under the 200 day, you know, is in a bear market. So here is Penn. So Penn here lost the 8 day, lost the 21 day, and also couldn't stay above the 200 day for more than one session. And then, you know, here too, couldn't get back above the moving averages, broke this level, and then it's been below the 8-21 day since. There's so many of these like this. Penn, obviously Peloton, FCell, UPST, AFRM, DraftKings. Everyone had an opinion with this one because everyone, for some reason, had a soft spot for friggin' Portnoy. But meanwhile, he obliterated people.
Is he the owner of that company or something?
He's the creator of Barstool. Barstool's like big sports comedy, whatever, and Penn National Gaming. It's like they like write articles, put out podcasts, videos. It's like more comedic, but they focus on sports. And Penn National Gaming bought them for I think like $400 million before COVID started, which looking back now is kind of like a big deal with all the $2 billion deals going on. But he's kind of like one of the heads now because he started, runs Barstool, and now Barstool is a big part of that.
But you know, during the pandemic, he came out and he started to be Davey Day Trader. So all the kids sitting at home and watching him, it was like stocks don't go down. We're buying. And a lot of people followed him. And then you can't just buy stocks. You need to have some sell rules. So I actually said to him, I'm like, be careful, Dave. Stocks do go down. And I tried to get into it with him a bunch of times. And P.S. Anyone who was in all of those type of names got DraftKings, Penn, got annihilated. And like.
Yeah, I
So.
made a nice chunk of change on that green up move with
Right here?
right there.
Yeah.
I sold right at the
Look.
top.
Okay. Well, look. It's above the 8-day. Broke this little thing 1, 2, 3, 4, and then right on this day was the day that said, nope, it's done.
I got out right
Yeah,
in the dojis, where all the dojis were going. I was like, I've made enough.
All right. Good. But again, like this candle right here engulfed this entire little range here. That said, get the hell out of the way.
Right.
And then here's a lower high, and then here's when it started to break down, and then boom.
That's a terrible one.
And then here again, they couldn't get back above the 8-day this entire time. While everybody was trying to catch a bottom. And now I don't even know what Penn is now. Where is it now? 40? Where is Penn right now? Check it.
It's,
This was 70.
About 40.
This was a 72 when it broke trend.
The bottom during March 2020 was like $4, and it went up to like 140 or something. Now it's down to 40.
Right.
Yeah.
So a lot of those things. So that's another thing. That's another thing to think about. Just because something was somewhere doesn't mean it's going to get back there, or just because something was somewhere doesn't mean it's cheap now. So if Penn was at 104, like a lot of those SPACs taught people a lot of those lessons. Like, just because Penn was 100 and you didn't get caught there, you could be buying it here at 70 because you didn't buy it at 140, and then that happens. So Peloton, another lesson, when it was in a strong trend, we played it from 25. I remember I got out somewhere around 90, and I missed the move to 140. And then some people are like, hey, it's 80, Red Dog. Why don't you take a look at it? I'm like, nah, I'm done with it. But like, well, you didn't get caught at 120. Try it at 80. I'm like, just because it was at 120 doesn't mean 80 is a good price. And obviously, it's at 25 now. But I'm just saying, some things go further than you thought, to squeeze people out and bait people in, and then they can go further down than you think. That's why you want to use calculated ways to buy them, whether it's a Red Dog reversal or something, because stocks could do whatever they want. So could crypto, so could anything. That's why, again, when you're tactical, you're not trying to catch a falling knife, because that's how you get a gusher and you can be put out of business. If you're tactical, you're trying to trade versus a level. So this way, if you lose versus a level, hey, you lose a little bit, big deal. But if you buy, you could get yourself in a lot of trouble as an active trader. So below the 8-day and the 21-day, you could love it and leave it. You could try it. Even ARK gave you a few trades for a day and a half, but then that was it.
But 99, that's what happened to me. I just kept buying, 2,000, buy. Then I wiped the whole account.
So did you do that ever again?
No.
Good, you learned
Well,
from it.
I
That was a
think
long time
that's-
ago.
That's when I became like, I had this massive bearish bias on stocks.
After?
Right.
'Cause you got
I left
stung.
a scar.
Yeah, you have to scar. You have to heal. You have to heal. This is DOCN, another one that broke the moving averages, and then every rally to it was sold, all the way down. High, lower high, lower high, lower high, below the moving averages. You're not sitting in it. You might trade it here and there, but until it reclaims it and starts a new active sequence. I feel like in the last year I started to talk a lot about active sequences, because active sequences is where we want to live. If you're in a bullish active sequence, you got to have risk on. You have to realize it's there. You have to get involved. You have to find the leaders. You got to stay with it. If you're in an active bearish sequence, you're out of the way. You're trying to be short. You're trying to be tactical, and you're waiting. Cash is a position. Brain power is a position. Human capital is just as important as equity capital, and at some point it'll change again. I remember before 2020, we say like I would make my year, 3 months out of the year, right? 3 months out of the year, there was always some kind of great active sequence that you would make money on, and then the other 9 months, you just gotta hope to, make a little bit, but then those 3 months are where you make the majority of your year. And that really was the way it was for, I remember, for most of my career. Until 2020, you had like 9 active sequences that really paid you. You know, if someone was breaking out, it went. Like if you were right, you were really right. You know, where second half of the last year, it's like you could be right and make a little, and it was hard to be right. So sometimes when you're right, you're really right. In that kind of market, you're getting rewarded, and it's awesome. Some markets, you know, you're right, but it's really hard, and sometimes it's hard to be right. So by rectifying or recognizing those situations, you know, again, saves you brain power and saves you, you know, equity power. So here again, you know, just downtrend. Final thoughts. Moving averages tell you the strength / weakness of trends. You know, focus on stocks and ETFs with real trends you could ride and ignore the rest. You know, sometimes you'll see something like energy stocks for a while were really hard, you know, or material stocks, because everyone's like, oh, but they're going up. I'm like, but they're just not trading well. You know, they go up, but it's like they're sloppy, they're loose, wide. You know, we like to be in trends that, you know, are tight and then resolve higher and then rest and then resolve higher, not whipsaw. You know, just gotta ignore some of that. You don't have to be in everything, right? Sometimes, like even on a rally day, like where we get this oversold bounce, you know, I'm in 3 things. Like, why aren't you in 10? I'm like, you don't need to be in 10 things to make money that day. You could be in 3 things. You know, you don't need to be in 20 things. You know, just be in what you can handle. You know, in this type of market, you don't need to be in 2nd, 3rd, 4th, or 5th tier stocks. Okay, you want to concentrate on the SPYs, the Qs, and maybe look at what's happening in the small caps and maybe ARK because it's helping with sentiment. You don't need to focus on illiquid stocks. You could, you know, trade bounces in the mega caps, you know, and like that's the kind of tape we're in. And then when we're in a trending tape, okay, you know, maybe you're in the leaders and then the rally starts to broaden and then you're in some mid caps and the rally starts to broaden and then you're in all of a sudden in 20 positions and every day, you know, you're buying a dip, you're selling some strength, you're playing trades and getting paid a lot of money. But when you're in a volatile tactical time, you're flat, you focus on a few things that give you clues and you focus on a few things that are liquid that you can get in and out of and then respect the money. I don't know how many times last week were you up money and then lost money on the day? Happened to me.
Every day? Almost every day.
Right. And you're like, holy.
Every day.
Well,
I'm like, I'm looking forward to taking Friday off.
Actually, it wasn't every day. It was like 3 out of 5.
yeah.
Right.
It happened to me like 3 out of 5 too. And we're all pros. It happens.
My SPY shorts were stopped within like a quarter, 25 cents.
So you had it in the wrong place.
Right.
You know, which do
But I
less
wasn't
size.
expecting
Yeah.
the
Either.
morning move.
No, because remember one day, you know, stopped at a prior low and then the next one went through it to the next one. So they definitely stopped out some shorts. So when I was looking back saying, how did I get stopped out? I'm like,
That's how.
oh, that's how. Right.